and we will get to them towards the end of each of our seminars. We'll get to those, and if we don't get to them during the seminar, I will make sure that we get a response to you just as soon as we can. So I'm going to, I guess, turn this over to Warren. And
Shelly, before we do that, is my sound okay? Do I need to call in, or is it okay from the computer?
No, you're great. Sound and visual are both good to go. And yeah, we will. Warren is our last one with an official seminar here, and then we're going to hear a little bit more from Steve Lucas with the storage group about our website, and Brian and I will wrap it up from there. So like I said, keep sending in your questions. I'll respond to them as soon as I can. You can do that through the Q&A at the bottom of the screen or through the chat module. All right, Warren, we're ready to go.
Awesome. So glad to be here with you guys. I've been blessed to be able to visit some of the state shows and of course the national shows as well. I'm based in Louisiana and have been delighted to speak in multiple opportunities. And I normally don't wear my glasses, but I'll give you a quick view. I live in Louisiana. I live close to the Mississippi River, and I had an allergic reaction to bug bites. I look like Rocky. Adrian! So anyway, I am going to share my screen with you guys, and we'll go over a little PowerPoint that we have. And some of it I will skip through, and some of it we'll cover in more detail to go with you guys. But let's see, Shelly or anybody else on the screen, can you guys see my screen okay?
I can see your screen.
Perfect, okay.
The CARE Act. All right, you're good.
Good deal. Again, delighted to be with you guys. Thanks so much for having us. And you know, we're in an unprecedented times, obviously, that we're doing this here on the, let me see my screen so I can see what I look like here. So, don't know how to get it on there, but that's okay. Anyway, you see, you know, the unprecedented times, we're turning to virtual webinars, we're doing all these things. And the biggest thing I think right now people are struggling with is cash flow. And cost segregation has been around for a long time. That's what we do. But the CARES Act has brought kind of a new lease to many building owners. And so we'll kind of go over that with you guys today. So why don't we fire it off? There you've got my contact information, and I will show a couple of times the a screen if you're interested in us running a pre-analysis on your property. When I showed that link, you can click on it, and while we're talking, we can cover that, and you can see what it's all about and what we can do for you. But we'll keep going here. All right. So generally, what the CARES Act does, everybody knows about the PPP SBA loans, or everybody's pursuing that, okay? The question we're getting is, hey, what other options are out there for the SBA loans that we can process and capture on? And now you really need to talk to your tax professionals about this, but there's a great opportunity where you can generate extra cash for lower income taxes, possibly a refund, and a couple other things that we'll talk about so that you can see. Okay, here's the biggest thing, kind of cut right to the chase. This has passive and active rules, so that means you need to be an owner-operator. If you are an investor, you can still benefit, but you can't capture this particular thing of the CARES Act. And so to see where that goes is that it allows for a 5-year carryback of a net operating loss arising in 2018, 19, or 20. What does that mean? Years ago, you could create a loss. Let's just say you had less or more expenses than you had income. That's a loss. In this case, you know, we're proposing that you can use a cost seg study to do that. So you create a cost seg study, it creates a loss. Since 2017, all you were able to do was roll that loss forward and zero out your tax liability in future years. So what the CARES Act did was the CARES Act said, if you create a loss and you pay for all of your taxes in 2019, then you're actually able to take that loss, bring it to 2014, 5 years prior, and with that, you can create a refund from your 2014 return. Okay, so how does that work? Okay, John Smith has income for the past 5 years. If you see on this chart, 14, 15, 16, 17, and 18, he had income coming in. In 2019, he said, hey, I'm gonna do a cost seg study on my self-storage facility. He created a loss of $425,000, okay? So that was after he paid off all his 2019 taxes. Then he worked with a CPA and did what's called a loss carryback form. You don't have to amend any returns in many cases, but he did a loss carryback form, and that takes him back to the year of 2014. So he had to pay taxes on $75,000 in 14, on $150,000 in 15, and $100,000 in 16. So he was able to use that loss from 2019 against that income, and the end result was it generated a tax refund of $115,000 in the 2019 tax year. So it's clear that whoever wrote the CARES Act was thinking in multiple layers and levels. So you as a business owner can apply for the PPP loans, but that's a limited pool of money. It could run out. You might not qualify. It might not be forgiven. This is another one that they clearly brought about, and they did it in prior years. In 2008 and 2009, when we had the economic hardships, they did it again. And basically, they're allowing to recycle money. Taxes that you paid in prior years, you can now capture and get now. And again, it's subject to passive or active rules. You have to be a real estate professional, or it has to be your kind of main business, an owner-operator. In some cases, like if you owned an Airbnb, like a short-term rental, that one would qualify to be able to generate this as well. So there's a lot of unique things that are out there that you guys should look into and make sure you have conversations with your tax professional about it. So the next big thing, and it will be less with the self-storage world, but I know sometimes we have managers who own apartment complexes, or maybe we have, we own apartment complexes ourselves, managers who live in the apartment complex. It's called qualified improvement property. And what that is the Congress in 2017 with the Tax Cuts and Jobs Act got rid of all types of leasehold improvements, like tenant improvements, like restaurant improvements, like retail improvements. And they lumped all the types of improvements under qualified improvement property. And they wanted it to qualify for bonus depreciation, but they wrote the law, the description of it incorrectly. The CARES Act corrects that. So what does this mean? A qualified improvement property is an internal improvement to a property. It can't be structural. It can't be elevator or escalator. But if you did an improvement in the last quarter of 17 or in 18 or in 19, or you've done one now in 20, pretty much most of that improvement, if it's an interior improvement, will qualify for what's called bonus depreciation. What does that mean? If I spend $100,000 fixing up the interior of my office space, or fixing up my office in a wine unit, for example, if it's not structural, not elevator, not escalator, I can write off the full balance of that as bonus depreciation immediately. So pretty impressive things. You can retroactively apply for bonus if you did an improvement in 17, 18, 19, particularly you guys that own other asset classes like apartment complexes or maybe restaurants or whatever. Those are all great opportunities for you to be able to do that. So what happens there? It creates a loss to offset your gains, and it could either reduce the taxes that you have to pay or potentially create a refund going back. And that's, again, what it does for you. Last one is going to apply to less people, but I will point this one out as well. And this one is a real estate losses. So the Tax Cuts and Jobs Act said, if you have active income, or if you're a real estate professional and you have a net business loss, that you could use that loss against other sources of income, like the stock market, for example. They put a cap on it of $250,000 per single person, $500,000 married filing jointly. The CARES Act temporarily suspends those things. So again, it's going to be fewer people that fall into this class, but what you're able to do now is you're able to use that loss in excess of your deductions, and you can do that to capture that. If you're looking at a 2018 return, 2018 is one of the situations where you're going to have to amend for some of these things. You would have to amend the 18 return and amend the 13, 14, 15 going forward. If you apply these things to 19 and 20, you should not have to do very many amendments. And there's some kind of special things that are still in play if you've already filed your taxes for 19. So who can benefit? It's not just self-storage owners, but it's anyone that's recently purchased or built. If you've owned a building for years, if you were a tenant that pays for improvements, or if you're an owner that pays for repairs and improvements. It works with estate planning and trusts, and all types of asset classes. Clearly, people that are going to benefit most are the ones that are landlords or multi-property owners. So our firm specializes in what's called cost segregation. Why is that important now? Well, for the CARES Act in particularly, a cost seg study allows you to create a loss to offset your income. If that loss is greater than your income in 2019, then you can use that loss to get a refund back from the IRS in some circumstances. For the Tax Cuts and Jobs Act, if you have a self-storage facility or any other type of building, you typically depreciate that building straight line over a certain amount of years. A cost seg allows you to identify 5, 7, 15-year asset classes. And from that, you can now capture bonus depreciation that the Tax Cuts and Jobs Act brought about. And the last one is the tangible property regs. They coach you on what you can expense and what you capitalize. When I talk to self-storage owners, they say, well, we just capitalize everything. And there are rules for that, and the tangible property regs define that. And when you do a cost seg study, a good cost seg firm will create what's called building systems definitions. And I won't go into it very much, but if you're replacing a part of your building, the building systems definition allows you to replace sometimes up to 30, 40% as an expense, and you don't have to capitalize that. A roof, for example, you got a leaky roof, you spend $100,000 replacing a third of it, you know, under the TPRs, you might be able to expense that. So we see cost seg as being the foundation of a lot of these tax laws, and the great thing, the CARES Act, it's doing it as well. So brief overview of cost seg, then I'll talk about specifically what are the opportunities that we have with the CARES Act now. So cost segregation is taking a building and breaking it out into parts and pieces, identifying 5, 7, and 15-year assets, in addition to the 39-year assets that you would see in a self-storage facility, or 27.5 if it's a residential rental. The end result is it creates more depreciation to offset your revenue, and the end result is lower income taxes. How much? Somewhere in the ballpark of $30,000 to $80,000 per million in cost. So if you have $1 million self-storage facility, and let's say you're able to put about 30% of it into a depreciation bucket that you can accelerate, that's a $300,000 deduction. If you multiply that times the 37% tax bracket, that's $110,000 in tax savings. The rule of thumb is 20 to 40% of your property. You can't do the whole building, but just a portion of it. And you know, buildings as small as 200,000. To be clear, it's not creating any new depreciation. But why do we do it now? Hey, I need cash flow now. I'm having a tough time paying my employees. I'm having a hard time collecting rent, whatever that might be. So I need cash flow now. So time value of money. You're pulling money out early that you can invest and use now so that you can keep your business going. So what are the types of things we depreciate in a self-storage facility? Your interior doors and your movable wall partitions, decorative building elements in your offices, maybe specialty electrical or plumbing. If you have a wine cellar, the HVAC and a lot of the wine cellar components are going to be a 5-year asset because they're unique. Lots of other things that we do, cabinets and countertops and bathrooms, security systems, you know, communications, fixtures, equipment. Here's some other examples of 15-year assets, and that's pretty much everything outside. Security lighting, landscaping, your paving. And if you see the graph, the blue line is straight line, the red line is cost segregation, and the green line is bonus depreciation. So what many people do is buy a building, $1 million, and they get 1/39 of it every year for 39 years. That's the blue line. The red line is what we would normally do without all these incentives. You get cost segregation, and you get about 30% of it early to invest, you know, back into something else, maybe invest in phase 2 or phase 3. And then it acts like straight line the remainder of it. And then the last one is bonus. And I'll talk about bonus briefly, but bonus basically is when you buy or build a building and put it into service, any building from 2007, the end of 2017 until now, you get 100% bonus. So you can depreciate all the assets that are 5, 7, and 15 years immediately when you put it in the service. Why does that help now? You can go back retroactively without amending the return, and you can capture that loss now to deal with this crazy coronavirus we're going through. So here's a great example of a case study. Client bought a $4 million strip center in 2015. They applied cost seg and in this case, potentially bonus depreciation. Creates $575,000 in tax deductions in 2019. So they use that to offset their income from 2019. Most people had a good year in 19. The self-storage world is kind of on a very high note for 2019. So you made $150,000. You use that $575,000 deduction from your cost segregation study to offset that gain. Okay, now two things can happen. You can either, in the case of passive income, roll it forward to continue reducing your income going forward. And now the tax you would have paid on that $150,000, you can use to pay your employees. You can use for whatever you need to. The other thing you can do now is if it's active income, you can take that $425,000 loss, apply that back to what we said in 2014, apply it to part of your income from 14, 15, and 16 until you use it up, and you generate a $115,000 refund for your 2019 tax year. So that's a very key point that the CARES Act brings about, and a cost seg study helps you get there. Here's a couple of examples from self-storage. If you see the 2017 purchase, little under $1 million, non-climate control, the tax savings is $45,000. 2018 construction climate control, 3.6 million. The tax savings was $569,000. So sometimes it's very, very significant, the benefit that you can get. It's pretty impressive, and it's there. A couple of other examples from different asset classes that you guys can see. One of the ways that we do this as a company is we provide a pre-analysis. So if you guys, I'll leave this up just for a minute or two, and if you're interested in taking a snippet of that or taking a picture while we're talking, you can go to that link. You can give me a little bit of data on your building, and it will generate a request for pre-analysis for me. So then I'll send that to my analysts. I'll send it back to you and say, hey, here's the potential tax savings that you can have from your building. Here's our fee to get it done. Let's have a conversation with your tax professional to see if this is something that you can benefit from. So great opportunity for that, https://bit.ly/CSSIW-DASIO. So I'm happy to send that to you. My contact information will be at the end, and you can ping me on that as well. So a couple other things that are available that just always want to point out: a partial asset disposition if you did a renovation or an improvement. This is not specifically CARES Act related, but it could generate cash for you right now on your taxes, which is something we pointed out for. A partial asset disposition is the ability to write off assets that are no longer in use. Suppose my roof, I buy a facility, I've been in it 10 years, the roof has gone to pot for whatever reason, I've got to replace that. I either decide to rip that metal roof off and throw it away, or I leave it in place and I put a new one on top of it. A renovation, a remodel, a replacement, abandoned in place, common items, a roof, HVAC, electrical. If it's just a single item, a lot of times your CPA can figure that out. If not, have them call us, your tax professional, and we will work with them to help capture this for you. If it's a big piece, then that's something that you might need us for. So you're ripping out, interior partitions, you're ripping out structure, you're ripping out concrete. We can go value that for you. And the value of the asset that's remaining, you can throw away. So the example of my roof, I've been in there 10 years. I've been depreciating it for 39 years, but now I'm throwing that old roof away. The IRS says if you can determine the value of that roof, then you can write off 29 years as an expense deduction today. What does that do? If I have a gain, if I have income, that deduction offsets that income and I pay less taxes. So right now, all the extensions happen, whether you paid an estimate, and are going to pay on the extension, or whether you waited and you're expecting to have to pay a certain amount of taxes. If you can reduce those taxes, that's cash you can use for something else. We had so many clients call us on LED retrofit projects. Hey, I'm tearing out old lights and throwing them in the trash. Most lights are 39-year assets. that we started an energy services division of our firm, and we do everything from audit to rebates to install to the tax piece, and wrap that all into one project and capture everything for the client. So great question for you. Did you renovate this year? Would be an important thing for you guys to look at and see if you can benefit from. Here's an example of an auto dealership that did it. And as you can see, they had a cost seg on the original building, a demolition, the partial asset disposition, and then a cost seg on the renovation, $300,000 in tax savings. Oops. Trying to get to you. There we go. So specifically, what does the CARES Act do? Okay. Excuse me. The last piece that we want to talk about is bonus depreciation. The CARES Act opened up bonus depreciation for qualified improvement property, which you kind of mentioned. So any kind of building that's bought or built since September 27th, 2017, to the last quarter of 17, 18, 19, about 20 to 40% of it is going to qualify for bonus depreciation. The CARES Act specifically adjusted qualified improvement property. So if you're doing an interior improvement for a property, then you can capture oftentimes 100% bonus on that. And what does that mean? That basically means in the case of an improvement, qualified improvement property, you're going to be able to deduct a significant amount of it now. In the case of a building, same thing, 20 to 40% you can deduct now. And again, that benchmark is 30 to 80,000 per million in costs in the first year. This is just an example about some different asset classes that show here's the value of that property and the total property cost. The last column is the projected savings that comes about for you guys so that you can see that from a benchmark. There's a self-storage facility in there at 2.7 million, a $220,000 tax event for that client. So last kind of few slides to kind of wrap up. Hey, I've already filed my taxes. Can I still benefit from these things? You know, what would be the process to do that? Number one, contact us, our reputable cost seg firm. Let them do a pre-analysis for you. You know, in this case, you would need to amend your 2019 tax return. But the good news is you have basically a whole year to do that. You can wait until, you know, up until you file your 2020 taxes. So the likely result would be increased depreciation and a refund from the taxes that you paid. So again, doing this now will generate cash flow. We're probably going to have a question, hey, do these processes generate audits? And in 2008 and 2009, a lot of different processes came up, and the government offered this as an opportunity for cash flow at that time. And there was no, you know, uptick in audits that happened there. So we don't expect it to do it again now. And the good news is too, is if you're ever audited on that, they can only audit you on that loss carryback. They can't audit you on something else you did in that tax year. Okay, so next one, hey, I've already filed my taxes. Can I still benefit? Okay, this is, I'm sorry, the one before was, you know, I purchased a building in 19. This is, hey, I've already filed my taxes and I own my building for multiple years already. Okay, the IRS allows what's called an automatic extension. Okay, and so you basically have 6 months from the time you filed. It's normally not allowed, but they're allowing it right now. And you have 6 months from the time that you filed to engage a cost seg study. If you like the benefit from that, the cost seg study goes through, you file what's called a 3115 change of accounting form, and you apply that to your 2019 tax return, and you get the benefit from that. So again, what's the potential? Increased depreciation. If it's active income, you might be able to get a refund to do any kind of loss back. If it's passive income, at the minimum, you can offset your passive income, and that cash that you paid, then you would get back again because you've already filed your taxes, the taxes you already paid. So, you know, again, last one, can I still capture it if I extended? You know, most people had to pay an estimate and then you extended your taxes. So only thing you do is do a cost seg study between now and when you finalize your taxes, apply it to 2019 and get a refund back on the taxes that you paid. Again, passive income, I can zero out my liability, and any extra loss I have, I roll that forward. And so, you know, hey, suppose I don't need it now, but I know I've got a 2020 estimate coming up for my quarterly estimates. Again, you can apply it towards that quarterly estimate. And again, that's usually cash that you're counting on and setting aside and knowing that. So in most ways, it's going to generate additional cash flow for building owners, and particularly in the self-storage world. So last kind of couple of slides, case study. In 2008, we had a restaurant owner that opened a second restaurant, and right as they opened that restaurant, the economy tanked. Less people were going out to eat. Less people were spending, disposable income, which is what's happening today. The client owed about $70,000 in taxes from their prior successful year. They completed a cost seg study through us. We generated that $70,000. Months later, they called us and said, "Hey, you guys are rock stars." They actually called our sales associate an angel for pulling them out. And they said, we're not sure if we would have been able to stay afloat. We might have had to close the first building in addition to the second one because of all that was going on. So again, this is an opportunity that's different from the PPP and SBA loan. And if you need cash flow now, it's worth exploring. Whether you're passive or active, there are lots of benefits for you right now, but the end result is less taxes and therefore cash that you can use for something else. Hey, we often get a lot of questions. Hey, my CPA has already done this, or my CPA has taken care of this. The easy answer is to run the numbers. Shelly knows a self-storage owner from Arizona that I did this for, and he said, "Hey, I think my CPA has done this, but I want you to review it." He gave me his depreciation schedule. I went back to that owner and I said, "Hey, your CPA is a rock star. They've done everything they could possibly get." The CPA called me a few months later and said, "Hey, I did this, but I've got a couple of complex projects I want you to work with me on." The flip side of that is we often get a client that'll say that, and we dig a little bit deeper, require looking at a depreciation schedule, and we say, "Hey, there's a little bit more that's left on the table. Your CPA might have only gotten carpeting in a parking lot, or maybe parking lot in your exterior doors, whatever. We'll go in and find 40% more." So that's just an example of that. I don't want to trigger an audit. I've addressed that already. We've done somewhere in the neighborhood of 20,000 of these studies and never triggered an audit. We don't expect so now. We have had to defend about a dozen clients, or represent a dozen clients who were audited by the IRS, and we represented them at no additional cost. And in every case, we had a happy client and a happy IRS agent. So very, very simple process. Last one, people ask us, what about recapture and 1031 exchanges? Does this still apply? Regarding recapture, the first process is there's a thing called diminished value. So let's say my interior doors, which I can depreciate at 5 years, I've owned my self-storage facility now for 10 years, and I was depreciating my doors at 5 years. In theory, you can say because those doors are 10 years old, they're not as good, so therefore the value is lower. Your parking lot, clearly, it's a 15-year asset. And you can say, hey, the parking lot's going to need to be resurfaced soon, so there's diminished value. But at the time of sale, you can assign a diminished value to the personal property that you've already peeled off, and assign a higher value to the structural items. And the last thing we often get people do is they'll perform a cost seg study on a new building to offset the cost seg study on the first building and kind of zero out that recapture. Same kind of process with the 1031 exchange. The 1031 exchange, you can only put real property now through a 1031 exchange. You can do your 15-year and your 39-year, but not your 5-year. So 5-year, as a result of the Tax Cuts and Jobs Act, won't pass through. So what many people do is they buy a building that has a larger basis on the back end, and we cost seg that second building, and that will offset the recapture from the first building. So the key there is to make sure there is a basis in your new property. Okay, so I'll give you an action item right after this slide, but how do you get started? If you want a pre-analysis, we can do that for you. We give us the type of building. Is it climate or non-climate? Is it an apartment complex? How much to pay for it? When did you acquire it? And what's the address? We'll generate a pre-analysis that says, here's the estimated tax savings, here's the cost. And then that's a perfect document for us to go and sit down with you and your tax professional to discuss and see if this is something that would work for you. There's a timing thing. Why would you not want to do it? Well, suppose I want to flip my property next year. You're only going to be able to hold that cash flow for a year, and you won't be able to invest it very long. So maybe that's not the right idea. However, I've had a investor one time say, hey, it's going to generate $1 million in tax savings for me. If I hold that a year and I can invest that at 8% back in my properties, I know that I can benefit from that, to the tune of $120,000 in interest on that $1 million. So there's strategies, but it's a good thing to just talk through. And lastly, there's a slide on who we are and what we're about, but action items, contact us for a pre-analysis, to look at cost segregation, partial asset disposition, qualified improvement property, a loss carryback, amended returns. If you're a tax pro out there, if you've got clients with buildings, you really ought to be looking at this forum. Look at clients who made renovations or improvements, apply bonus depreciation. Is it worth doing a loss carryback and possible amendment? And real simple process, but there's my contact information. We've got about 5 minutes, I think, for questions. I'm happy to answer a few questions if anybody has any. Shelly, you there?
I am here. Can you see the Q&A down at the bottom of the screen? We had about 3, maybe 4 questions come in.
Let me stop my sharing and I will be able to pull up the Q&A. 1 second. Okay. There it is. Okay, let's see. Does the CARES Act only kick in if you lose money in 2019? If revenues are down, but you have not lost enough money that you have a loss, does this not help? The CARES Act only allows you to do a refund if you have a loss. But you could do a cost seg study and it still not create a loss for you, but it still could generate cash flow for you. So in other words, if I had if I made $200,000 in revenue and I did a cost seg study and that generated $100,000 in loss for me, then I would get the tax savings based on $100,000 deduction. It wouldn't be a loss that would carry back. You still could have a gain and save money that way. So there's one thing that you can do. If you sell a facility and have done a cost segregation study, do you have to disclose the cost segregation to the buyer? A property that has been cost segged, is it eligible for a 1031 exchange? So I don't think you have to disclose whether or not you have done a cost seg study to the client. I think that is based on your accounting side and it has no relevance on his side. Does a property, is it eligible for a 1031 exchange? When we do a cost seg study, we peel out 5, 7, 15, and 39-year assets. The 5-year assets do not transfer in a 1031 exchange. The 15 and the 39-year assets do. So a portion of it does and a portion of it doesn't. And I kind of addressed that when I said if with a 1031 exchange, as long as you have a little bit of basis in the new building, you can cost seg that. And that oftentimes will offset the recapture that doesn't flow through from a 1031 exchange. Someone says, what are the implications for taking accelerated depreciation in these banks when you're working on refis? Is it frowned upon by the bank? No. Terry Campbell with Live Oak Bank, he recommends this to his clients because he knows, banks understand depreciation now. And if they see, hey, I had X amount of revenue, but I used X amount of depreciation to offset that revenue, banks get it, so they see that. So Terry Campbell is one of the guys, I'm sure he wouldn't mind me saying it, that he'll recommend this to his clients. And why? Because it gives them more cash flow. He knows they're more debt worthy now. He knows they're more liable to pay back their loans that he's provided for them. So I think maybe when deductions were not fully understood, it might have been frowned upon, but now banks get it. They know that you're using strategy to do it. If we've already gone through a cost seg, can we still take advantage of the partial asset disposition if we did a substantial remodel since? Yes, you absolutely can. We have clients that auto dealership that I showed, we did a cost seg study for them. And then years later, they said, hey, we're going to renovate. And so we did a partial asset disposition on the renovation and then a cost seg on the improvement that they put in. There is a key for a partial asset disposition though. You can only capture that benefit in the same tax year as you do the renovation. So if you did a 2019 or 2020 renovation, you still have time to capture the benefit. If you did a 2018, you can capture some, like you could go back in and say, what were the removal costs of that? And you file what's called a 3115 change of accounting form. You don't have to amend a return. But if you did it in 19 or 20, that's where the biggest opportunity is right now for you guys. See, I think, did one other one come in, Shelly, or did it get them all?
No, I think there's might have been one that we missed. Did you see the one from Jennifer Schilling? You sell a facility and did a cost segregation. Do you have to disclose
Yes.
cost segregation to the buyer?
I'm not 100% sure, Jennifer, because I'm not familiar with Form 8594, but I don't think you do. If you email me, my email is on the screen there. I will be happy to find that answer for you. And I've got a team, we've got quite a back office, and one of my team members will be able to answer that question. I don't think you do, but I'd love to verify it for you. So shoot me an email and I'd be happy to get that answer for you. All right, well, that's me. If you guys are interested in us just running the numbers for you, we'd be delighted to do that. And then we use that as a talking point to sit down with your tax professional and see if you can benefit from it. We'd be delighted to do so. The easy answer is it doesn't cost anything to run the numbers. And so that's a great talking point with your CPA. And not only that, your tax professional is just swamped now. If there's something else we can take off of their plate, create a pre-analysis, have a quick phone call with them and say, yeah, this is something we can benefit from. I know that they're swamped dealing with SBA, the PPP loans, finding payroll stuff. I know they're swamped with just, all the questions they're getting, and cut those guys slack because they're not going to get a break this year. Normally April 15th would pass and they'd get a little break. They're going to be plugging away until well into January now and early March to get next year's return. So thank you guys for having me, Shelly. I appreciate the time, and all of you guys that are here. If we can help you in any way, please let us know.
Yeah, Warren has worked with the Missouri Association for a long time, and if anyone needs any references from him, I'm happy to track those down or give one personally. Thank you, Warren.